Hi, everyone. Can you hear me? Assume yes. Okay, well, thank you very much to the organizers for putting our paper on the program. This is joint work, as you can see, with Ludovica Ambrosino, who's a PhD student at LBS, and Silvana Tenreyro at the LSE. How do I advance the slides? Oh, yes. Okay, thanks. Thank you. So let's start with some context for our paper. As you can tell, in recent decades, global trends have shifted quite noticeably. So as you can see, this long post-war increase in trade openness has stalled, as you can see from this figure, which shows global trade to GDP plateauing after the global financial crisis. Moreover, we also know that underlying many of these trends is that trade is increasingly being influenced by geopolitics here. And so we have a fragmentation index that's put together by Jesus Fernandez Villaverde and his co-authors, and it shows that since the global financial crisis, fragmentation has been increasing gradually, spiking up around the pandemic and the war in Ukraine. Okay. And so these trends are also likely to persist. There are many things that are being normalized, friendshoring and realignment of trade towards geopolitically friendly countries. Now, the key takeaway that I want you to take from these first two figures is that this is not necessarily going to be reflected in a fall in trade openness, but a realignment of trade from the most efficient suppliers to the more geopolitically friendly ones. And so for many countries, then trade fragmentation driven by geopolitics is likely to lead to higher imported goods prices and lower real incomes. And against this backdrop, two concrete questions that we will address are going to be, will fragmentation lead to a high inflation environment? And what would be the monetary policy response that's needed to keep inflation at target? Let me give you a preview of our answers. Okay, on the first one, will fragmentation lead to a high inflation environment? So in principle, no. This does not mean, well, in principle, this does not mean that central banks need to change their remits. But a better way to rephrase this question, especially given the policy panel yesterday, is will fragmentation lead to higher inflationary pressures, even if inflation ultimately returns to target because of actions taken by the central bank? And the answer to this question is it depends. Okay, so we show that in some scenarios, for example, when fragmentation is very front-loaded, so you can think something similar to what happened with the war in Ukraine, this can lead to a stagflationary scenario for policymakers. So with a spike in inflation and a fall in outputs would lead to a short-term trade-off for policymakers. But this is one possibility. While this is one possibility, another could be that if fragmentation is gradual and anticipated, so kind of like the unwinding of globalization, this can lead to stagnation. So with lower real incomes and lower domestic disinflationary pressures. And this leads to the second question, what is the monetary policy response then needed to keep inflation at target? Or how will equilibrium R-star respond? And here, of course, the answer it follows that it also depends. It really depends on how demand responds to permanently lower incomes. And if fragmentation leads to a sharp fall in demand, this could lower R-star. All right, so just very quickly over the literature, we build on some classic models in the literature, Benigno and Benigno, Smith-Gohi and Uribe, Galli and Monticelli, Santacreu and De Paoli, also some work by Giancarlo. I want to highlight, of course, this builds on the earlier literature on globalization and the newer literature on the impact of tariffs, which Alberto has contributed to. And on the empirical front, I just want to highlight one strand. So many people seem to attribute globalization to a fall in inflation. Well, sorry, a global integration to a fall in inflation. And on this front, there's some interesting empirical work by authors at the ECB, so Atanasi and Balati. Irwan has contributed to this with his co-authors at the Banque de France. Also at the Bank of England, we have Lewis and Salahin. And they show that they make a compelling case that it was really monetary policy and the introduction of targets that led to a fall in inflation. So this link, a causal link, is elusive. What we're not trying to challenge is that, of course, it led to a fall in tradables inflation, but what happens on the demand side is also quite important as well. If monetary policy keeps the nominal anchor, it's not necessarily the case that fragmentation leads to higher inflationary pressures. Okay. Okay, just I'm going to go over the model a bit. Might be a bit repetitive. I'm going to give you a summary and then a bird's eye view of the production structure of this economy and then go into detail. But I've heard that the model is not small, so maybe it's better to err on the side of being a bit repetitive. Just to summarize, we have a small open economy model, New Keynesian model, with two types of households, unconstrained and constrained households. The unconstrained are your usual representative agent households. Okay, so they maximize utility over consumption, labor supply, asset holdings, subject to their budget constraints. We also have constrained households who spend all of their disposable income within a period. They supply labor, so this is labor income. Firms are standard, they maximize profits given production technology. We have two types of firms, well, two sectors. We have a non-tradable sector where there's monopolistic competition and sticky prices. And we have a tradable sector, which, domestic tradable sector, where prices are set internationally. Other prices are flexible. Okay. In this home economy, which is the one that we analyze, we take the rest of the world's dynamics to be exogenous. This home economy trades consumption goods and imports foreign goods. They trade also domestic and international bonds, and it is the unconstrained households that undertake this. Constrained households, again, they have no access to financial markets. The unconstrained households, they trade these riskless domestic and foreign bonds, and there's a quadratic cost in changing the real asset position. We have a monetary policy rule where they respond to deviations of CPI from target. And this is just a bird's eye view of the economy. What I've discussed, it's the picture of the small open economy that we analyze. Two types of households. They supply labor to domestic production and they consume domestically. There are two sectors in the economy, tradable sector exports to the rest of the world. Unconstrained households borrow. They can borrow from the rest of the world. And the import price shock that we're going to look at is going to affect the domestic economy through the left side of the chart, which shows an effect on imported inputs in non-tradables production. You can think of this as energy. And it also affects the final consumption good of part of the consumption basket. So the consumption basket of households will have non-tradables, tradables, and then tradables will be home tradables and foreign produced tradables. Okay, so let me just go into a bit more detail about the various blocks in the economy then. These are household preferences. They maximize expected lifetime utility. Consumption basket is CS aggregate of tradable and non-tradable goods. 1 minus var sigma is the share of tradable goods in consumption. And in turn, tradable goods is composed of home tradable goods and foreign tradable goods. 1 minus theta is the home bias of the economy. So a more open economy is going to be more adversely affected by these foreign shocks. Non-tradable goods are a CS aggregate of individual varieties, and epsilon is the elasticity of substitution between these varieties. Now the prices just follow from the nesting that we've introduced. The aggregate price level composed of tradables and non-tradables prices. Tradables prices composed of home tradable prices and foreign tradable prices, and non-tradable goods prices is a composite of the individual varieties. PFT is what we're going to shock in the first two simulations of this. So I'll take you through a few simulations to show the impact. For households, we have the unconstrained ones. These are your standard representative agent ones. Oh, sorry. These are the unconstrained households. They have access to foreign and domestic bonds. Budget constraints and real variables show that they can borrow domestically and from abroad. There's a cost in changing the portfolio position. They receive firm profits. They have labor. They supply labor, so they receive labor income. And this is what they consume out of. So for the unconstrained households, of course, they have optimal labor so this is still the unconstrained households. Their first order conditions give you optimal labor supply, Euler equation, and the UIP condition, which holds up to the cost of changing these bond positions. For the constrained households, they have a much simpler budget constraint. They supply labor optimally, but they consume all of their labor income within the period. Now I'll take you through the firms, starting with the non-tradable sector. So this is the domestic sector. Production is Cobb Douglas. So it takes intermediate inputs and labor, domestic labor, and they take the price of these inputs as given. So with labor, with wage rate W, and imported input with the foreign price. There's monopolistic competition in this market, and there's sticky pricing, Rotenberg pricing, and so there's production is there's going to be some efficiency loss there because of the price of adjustments. In the tradable sector, firms produce just using labor, and the sector is internationally competitive, takes global prices as given. Labor is used in both sectors. Okay. And the calibration is, there's some more detail in the paper. I just want to highlight that we deviate from log utility, and we assume unitary elasticities of substitution. We think this is a reasonable assumption for globalization, which takes place over a period of time. But we also have varying elasticities of substitution in an extension, and I'll tell you a bit more about the results from there. So just to show, and what we want to highlight with this is that we want to highlight with all three different types of fragmentation scenarios that the supply side is going to be constrained with this trade fragmentation. But what really matters, and what we want to highlight with the different scenarios, is that the demand side impact also matters. And it's going to differ in each of the different scenarios, okay? So for example, the first one that we have is the gradual scenario, and this is the one that leads to stagnation. This is one where the price of imported goods increases gradually and permanently, stabilizing at a higher level in the medium to long term. Front-loaded fragmentation, on the other hand, takes place immediately. So the price of these goods just increases permanently and immediately. And lastly, there's also a fall in tradable sector productivity. So TFP in the tradable sector falls persistently. Okay. And so I'll take you through first the gradual scenario, and I'll do this in a rank model because it's cleaner and it's easier to see the intuition here. So we have a gradual increase in the foreign price level, which you can see from the figure on the bottom. And this increase is anticipated. Consumption falls in anticipation of lower real income. So these are all representative agents. They adjust consumption in response to permanently lower incomes. Labor demand falls while labor supply increases. This is wealth effect. And real wages fall. So there's less consumption and more labor effort given the worst terms of trade in this scenario. But I can show you what happens to prices then. So the fall in demand is reflected in the fall in the natural rate of interest here. Inflation, which you should look at, is aggregate CPI inflation. That falls because the domestic components of inflation fall. So domestic components of inflation are given by non-tradables inflation. You can see that it falls over a long period of time and ultimately recovers. But this, more importantly, you have to contrast it to imported inflation. So there's a spike up in imported inflation and the foreign price level increases. But this is not enough to outweigh the fall in non-tradables inflation. So this is a situation of stagnation. Monetary policy actually has to loosen in order to bring inflation, CPI inflation, back to target. Now contrast this to the case where there's a front-loaded increase in import prices. So foreign price level, you can see on the last panel, increases immediately and permanently. And consumption and real wages fall, but the natural rate of interest does not change. So CPI inflation increases. So aggregate CPI inflation is what we should be looking at. This is even though the domestic components of inflation fall. So we also have a fall in non-tradables inflation here, but it's really short-lived. It recovers immediately, almost immediately. And more importantly, it's not enough to outweigh the high spike in imported inflation. So this is a scenario that results in a trade-off for policymakers. It's stagflationary. Aggregate CPI inflation increases, activity falls. And this is one where monetary policy ends up needing to tighten in response to the spike in CPI inflation. Okay. Now, another scenario that could happen is that tradables TFP just deteriorates and stays permanently lower. So we have here a gradual fall in domestic tradables TFP sector. So this is a purely domestic shock. Consumption here falls as well. Natural rate of interest also falls. There's an initial increase in CPI inflation, but it follows by permanent fall. Monetary policy needs to tighten first and then loosen. So next, I'll take you through the scenario where we introduce some hand-to-mouth households in a tank. Okay, so the initial motivation for the scenario was to introduce some hand-to-mouth households, which cannot they cannot react to the import price shock in anticipation. Okay, but it turns out that there are also, so this lessens the anticipation effect, but it turns out there are also demand spillovers. As the unconstrained households pull back in consumption, this affects labor income of the constrained households. So there's not, you can see the difference. The fall, there's a slightly larger fall in consumption. You can see that the constrained households decrease consumption by more. They are unable to smooth, but these two effects result in pretty similar outcomes for the prices. There's a larger degree of reallocation from the non-tradable sector to the tradable sector here because of the constrained households. But other than that, we get similar outcomes for inflation. So our results are robust to the introduction of these households. Similar balances as in the rank. And this is still a case in which the gradual scenario is one in which it's stagnant. So you have a fall in inflation, a fall in activity, and a fall in the natural real rates. Okay. Similar for a front-loaded scenario, there's slightly larger fall in consumption and reallocation towards tradables, but same leads to fairly similar outcomes across tank and rank, and not much difference in inflation or the natural real rates. This is still one that leads to stagflation, the front-loaded scenario. And same for the tank TFP shock. We don't have much difference between the rank and the tank. Okay. The degree of openness is a bit more interesting. We vary the degree to which this domestic economy is exposed to these price shocks, these foreign price shocks. And so just the major takeaway from this is that, yes, there's higher exposure as trade openness increases. There's more adverse outcomes in the more open economy, which is the blue line. And then followed by the black dashed, and then the red economy is the most closed one. So it leads to larger falls in consumption wages in the more open economy and more reallocation towards home tradables. Interesting baseline is the nearly closed economy, the red dashed line. So there, imported inputs mainly affect non-tradables production. And then the additional, the blue and the black dashed are what happens when we increase the consumption basket to have more foreign tradables. So the rest, what's coming from that is the demand side effect from the effect on the consumption basket. Okay, so otherwise in the red economy, it just affects the price of imported inputs for non-tradables production. You can see there's a fall non-tradables output and employment, yeah, so a fall in the real wage as well. Okay, so similar outcomes for, yeah, so this is still the gradual case. Higher exposure leads to larger domestic adjustment in these prices, leads to larger fall in domestic components of inflation and natural rate of interest. So this is still a stagnation scenario, but it's more so in the case of an open economy. Now, in the case in which we have a front-loaded increase in import prices, leads to a more difficult trade-off for policymakers. So you have more adverse outcomes and lower demand, lower real wages, but higher CPI inflation. But importantly, natural real rate does not change here as well. Okay. And for the gradual TFP shock, this is a purely domestic shock. Okay, so openness matters a bit less. We have a fall, so it's not shown here, but in the paper, you can see there's a fall in output. Consumption is actually, the intuition is a bit more clean in the rank. Consumption here actually is more adversely affected in the open economy because of the distribution of profits. Profits are actually more adversely affected. So the unconstrained households take a bigger hit in the more open economy. But this is a case where we wanted to show that for a purely domestic shock, actually being open helps. So it actually, the outcomes on outputs are less adverse because you can diversify away from the affected home tradable sector. Okay, so we have a few extensions in the paper. We just show that, for example, what would you think of, so what happens when we have more constraints on domestic supply? So for example, if you're more dependent on foreign inputs for production, when there's wage stickiness, and so in these, across all of these scenarios, all these extensions, also with more flexible prices and non-unitary lattices of substitution, we get the same conclusions across our scenarios. Gradual is still stagnant, front-loaded is still leads to a trade-off, and TFP leads to a mild increase in inflation. But the demand side effects are preserved across the scenarios, and I'll just give you some quick intuition as to why that is, why we still have our conclusions holding. So when there's a higher share of foreign inputs in production, this leads to a larger fall in consumption real wages because of in response to increase in foreign prices. So the increase in foreign prices is a tighter constraint on domestic supplies, import prices increase. There's some factor substitution towards labor to the extent that that can happen with Cobb-Douglas, but it's not enough to stimulate aggregate demand. And moreover, so we get that the gradual scenario is the demand side effects are preserved there. But it seems to matter a bit more for the aggregate TFP scenario, where it's a little bit less inflationary, because now that non-tradables production depends more on inputs and less on labor, it's less able to absorb labor from the effect of import prices on home tradables. Okay. So this leads to less inflationary pressures in the non-tradable sector, which leads to less aggregate CPI inflation in general. Wage stickiness is a bit interesting as well. Overall, it moderates the fall in wage inflation, but it also leads to a larger decline in employment, so quantities adjust, and so labor incomes are preserved in the scenario. The gradual scenario is less disinflationary because for a given fall in outputs, aggregate CPI is actually the same. So output falls by more, but CPI is the same. So this is a less disinflationary scenario. It leads to worse trade-offs in the front-loaded scenario. So aggregate CPI is actually higher in impact and more persistent and leads to worsens the policy trade-off. More flexible prices. One of the frictions that we have in this model is that, is that non-tradable sector is the sticky sector, and the inability to adjust prices leads to adjustments in quantities. So actually, if we have more flexible prices, this increases disinflationary pressures in the gradual scenario, and it actually lessens the policy trade-off in the front-loaded one. We also have one with different elasticities of substitution, leads to less stagnation in the gradual scenario. But overall, our conclusions across the 3 different scenarios are the same, just the underlying mechanisms are slightly different. So just to quickly conclude, fragmentation may lead to higher import prices and lower supply, lowering real incomes. Now, the impact on domestic aggregate and CPI inflation really depends on how demand adjusts to lower incomes, which in turn depends on how fragmentation materializes. So we show that in the case where it's gradual, it could lead to stagnation with low real incomes and low inflationary pressures, and this is where monetary policy might actually need to loosen. Front-loaded scenario leads to trade-offs or stagflation. Persistent falls in tradable TFP can lead to stagnation and lower interest rates. We show that it depends on the calibration, can also lead to a moderate increase in inflation. And how monetary policy should respond really depends on the balance of supply and demand, and the policy direction is a priori ambiguous. So some next steps, we can also consider other types of fragmentation scenarios. For example, this is anticipated, could be that you have unanticipated sustained increases. We abstract from lags in policy transmission and the fiscal policy response. Of course, you can also have non-rational inflation expectations. So just quickly and briefly, just to step outside the model and think of like bigger picture implications. I think it's just pretty obvious that, to tackle real side geopolitical issues requires perhaps real side policies, and monetary policy might need to, in the events where these are absent, monetary policy might need to address the residual effects of this. But some real side policies to prevent, mitigate, or cope with these impacts of geopolitical developments would be investments in diversification of technology, focused on low substitutability inputs or technologies, deeper integration with low-risk countries to reduce exposure to these shocks, and inventory basis to prepare for shortages in critical inputs. And with that, that's pretty much it. Thank you very much.
Thank you.
Looking forward to Giancarlo's discussion.
Thank you, Gianni. Lots of material to think about. I count on Giancarlo for making me at least understand some of the channels better.
Thank you for inviting me. It's nice to be back in this room. I've been here for many, many years, in a lot of times, the Monetary Institute. So, how does it work? Oh, yeah. So, I like this paper. I mean, it shows basically how you can think of good policy drawing on good economics. So I'm going to do exactly what Chiara asked, going back to very simple principle. So the question is clear: how will trade fragmentation impact on monetary policy? We understand import intermediate prices going up is a production cost, inflationary pressure. There is also a problem with employment. But fragmentation also impacts wealth and demand. So in principle, we could have a scenario in which wealth effect and demand prevail, so low natural rate, low inflation, or a scenario in which supply effects prevail. In that case, we have a stagflationary scenario. So you could do big models, or you could do a pretty stylized, although sophisticated model, and use economics 101, which is terms of trade versus productivity shock, current versus anticipated. So why is that interesting? Well, you know, in a way, we can think of intermediate inputs, prices coming from disruption, which is terms of trade shock. And you can think of problems linked to technology, innovation, migration that may bring in an effect on the TFP. So that's the motivation. So what are the theoretical foundations that are very basic, that shape the analysis? One is obvious, sorry to say this. Shocks are shocks. They have demand and supply effects. There are no supply shocks and demand shocks. There are shocks fundamental with demand and supply effects. Within complete markets, shocks may have significant wealth effects driving demand. And they drive demand in two ways. The first one, if I count only on my real wages, for example, relative price changes affect my wealth and demand. Income effect come from large changes in relative price that can be endogenous or exogenous. And of course, reflect anticipation of real income in the future. No? Notice the difference. Usually when we think of real relative prices, we think of short run, low elasticity that may come into creating issue with JVC disruption. The elasticity is low. All of a sudden, I don't have an intermediate input. Prices move a lot. They feed this kind of supply price effect on real incomes. When instead we think about the long run anticipated shocks, we think that we will move out from JVC as we know into something else. So the elasticity may be higher, but this makes any kind of output effect in the future even more important for me because the price does not change much. The output may change quite a bit, for example, with TFP. And the last thing, if you have multiple sector and multiple agent, which is if you really face reality, there is something more in the policy trade-off than just aggregate output, aggregate employment, because there is relative price misalignment in sectors, misalignment in demand, or demand imbalances. And this all comes into your loss function. So Luca is here, Simon Lloyd is in England. We have been working a lot on these wealth effects with a lot of papers, including the new macroeconomics book by Per Crusell et al., chapter 23. Please read it because it's all about you cannot do really international monetary policy, meaning you cannot do monetary policy if you don't understand this kind of international aspect and dynamics of wealth effect that are rediscovered even in a closed economy. When we talk about Keynesian supply shock, it's the same thing. And also about the relevance of this trade elasticity debate for macro comes from this work from Auclair and al., in which they use these very low elasticities to show that actually relative price can impact when you have hand-to-mouth consumer quite a bit. And last bit, the loss function, you need to track sector reallocation, relative price misalignment when you do monetary policy, because those are relevant to people, they're costly to reallocate agents or people across sectors. So let me tell you very briefly the building block of the model. There is an economic structure with New Keynes and Rothenberg, two sectors. One is competitive flex price, the other one is sticky price. The sticky price is non-tradable and it only uses intermediate inputs. You have lots of Ballast-Samuelson effect that actually were crucial in explaining the pound depreciation after Brexit that the other models could not really fit, thanks to Silvana. There is a small open economy, so you can take relative price as given, and there are two types of agent, as explained. By the way, tank and rank in open economy makes no sense because you have more than one representative agent. So you would have a national representative, so you could call it N-tank, or you could call it T-tank, which is two representative agent. We asked ChatGPT if he came out with this T-tank idea, or T-rank. So this is the T-rank and the T-tank model. So I'm some problem. You know, like in the way that the paper, it could be at some point explore more about the elasticities. You could put more intermediates in the model, more nominal rigidities like the previous paper, and a little bit of discussion on natural rate allocation. But it's fine. I'll talk later. Distortion, remember, there is one sector with one nominal rigidity, and second, there is incomplete market. So let me tell you the story, the answer to Chiara. So suppose I have a permanent adverse terms of trade effect occurring at once. In a flex price equilibrium, you will have a negative wealth effect driving consumption down, labor supply up, and real wage down. It's all like a general equilibrium responses. What is important is that there will be a change in the relative price, right? Which will drive reallocation in demand and employment from the non-tradable to the tradable sector because the non-tradable has become less efficient and more costly. Now, with sticky price, actually, you could just target this thing. How do you do that? Because we have only one rigidity, PPI works. If you define PPI as targeting the core inflation with the sector with nominal rigidity. So what you do, you want to prevent sticky price firms from changing prices because that is a waste of money, no, into the costly adjustment, waste of resources into the cost adjustment of prices. So you let the CPI accommodate relative price, okay? You call it CPI inflation, but it's actually an efficient relative price movement. So the lesson is that if you do CPI target in this world, it's not good, right? It's too contractionary. You forget that there is an efficient relative price adjustment. You try to lean against it, which means that basically you contract consumption too much. You don't let the relative price to adjust. And you also get inefficient, excessive reallocation of employment in the short run. So if you look at this figure, if you look to the right of each graph, you'll see the long run. If you look to the left at the beginning, you will see excessive reallocation of the excessive reallocation across sector, where you overshoot the reallocation. You get too much reallocation to the tradable, then comes back to the long run. And remember, reallocation is costless in our model, not in reality. Not in reality. And my answer is that it may be the same order of magnitude, if not more than inflation. So you want to, you cannot ignore relative price. You cannot ignore this kind of dynamics as policymaker. By the way, it would be nice to plot the relative price here in the, this is a complaint I have. The only complaint with Jenny, just plot the dynamic of the relative price here. So now, suppose, again, in T-rank, that the problem is coming, it's gradual, not tomorrow. Tomorrow we'll have this adverse terms of trade shock. Well, you know, immediately you have a negative wealth effect. You understand that you're poorer tomorrow. So that means dropping consumption, a little bit of adjustment labor supply, deflationary pressure, okay? So if monetary policy failed to understand that, failed to expand enough to keep consumption up today, that means the firms that get costly adjustment price will start dropping prices, wasting resources. You don't want that, okay? So you want to avoid the misalignment in relative price. You want to avoid the excessive allocation. You need to push a little bit up, okay? And the reason why it's good is because in a way, tomorrow is the problem. Today is nothing. In this model, there is no capital anticipation. So basically, you wait until tomorrow to adjust. Today, you just want to keep things as they are. Now, again, a suboptimal monetary policy lets deflation to phase in upfront. And that means that you are stuck with a period of expansionary policy just to bring inflation back to target, right? You don't take advantage of the flexibility of PF and PN in the model, price of tradable. And so basically, you push on CPI, forcing cost adjustment in sticky prices to rebalance relative prices. Okay, so end-tank. Now, end-tank, hand-to-mouth plus whatever. So here, if you look at these pictures, there is no big difference. Okay, the aggregate is almost the same. I think this is always, we always thought about, the financial autarky versus a component of the economy that works in financial autarky, the hand-to-mouth and the other guys. So how can we think that this financial autarky aspect is important? Well, you need to sort of let the model generate plausible price adjustment. And I would actually sort of play around with this new literature, taking seriously that the elasticities are low in the short run and adjust in the long run. This is actually GVC disruption. Low elasticity now in the short run, high elasticity in the long run. Lots of work by George Alessandria. Cooley and Quadrini have an old paper that we know very well. Auclair is shameless. Elasticity 0.1. And he gets a lot of action to 0.1 is really, like basically, I cannot live without a gadget from China. So to conclude, must read, must think about project, must read paper. And I think there are two issues that could sort of make us think about monetary policy in the future. The first one is, to what extent macrodynamics is shaped by the two-way feedbacks with heterogeneous dynamics in sectors and along the income distribution and along the groups that may or may not participate in financial market. This is an old question. I just push sector aspect in it because we have the relative price now coming in pretty strong. And more important, what is the core inflation to target? What is the appropriate stance, right? In the previous paper, there were layers of price rigidity. So my simple natural rate does not work. And actually with Bank of Canada, we have now looking into the tariff, again, lots of work with wholesale, retail, and production along the input-output table to see how, for example, price adjustment may become more coordinated with large shock relative to price adjustment less coordinated. So this, I think, is a beautiful new agenda, ideally bringing forward more evidence and theory about the dynamic of trade fragmentation, and I insist, short and long run elasticities. And I would add one thing which I'm working now most of the time, which is market structure. Those are markets populated by a few large firms. Trade disruption means oligopolistic change in the structure of the market. When you do Baccai-Fari, you don't have entry-exit. When all this kind of stuff that come from macro sort of ignore this aspect, and I think it's something we should think more about. Thank you very much.
Thank you very much, Giancarlo. Great presentation and great discussion. So I still have one question, but I want to first hear from the audience, if there are any. Guido again, let's see, I'm very curious.
Monopolizing, no, but and I hope I'm not stealing Chiara's question. Okay. So for the first time, I want to talk about trend inflation. So when I think about this fragmentation, I think about actually there will be less international trade, especially intermediate goods, and therefore I want to be provocative. That's, I think, is good news at the end of the day for monetary policy. And let me explain why. So I think the presenter mentioned some papers about determinants of trend inflation. I have a paper with Luca Foss and JIE that shows that actually the China shock, when China enters the WTO, had a permanent deflationary pressures on in the U.S. Inflation. And and monetary policy also was important, of course, inflation targeting. But the other thing, if you look at the cyclical instead impact, is that, of course, then you have more of your marginal cost as a firm that coming from abroad. And then immediately, there is some literature about, the implication for the Nikkei-Phillips curve when you have international trade. Of course, make inflation less controllable by monetary policy. And simply because monetary policy affects inflation through the labor market and wages, so and domestic, the price of domestic input, right? So if a lot of your marginal cost is actually coming from, India or China or whatever, that means that actually monetary policy power to affect inflation is actually very, very low. And so actually, I think I conclude that globalization is good news for monetary policy. That actually China was basically pushing out of business because they couldn't control inflation any longer. Autarky is fantastic for monetary policy.
Maybe back to Jenny, and then we see other questions.
First of all, thank you, Giancarlo, for the excellent discussion. I mean, points taken. It is true. The only sector that we have that is a sticky price sector is the non-tradables. CPI inflation targeting CPI inflation is suboptimal. But we also have a tradable sector that is domestic and which is not subject to sticky prices. So we would ideally just want to target the non-tradable sector. PPI goes a bit closer to that, but it's still not ideal. The optimal allocations that we do, so I didn't have time to present, but we do look at what a social planner would do. And there it highlights a lot of the inefficiencies that Giancarlo also mentioned in his discussion. That there's too much reallocation from non-tradables to home tradables. There should be some in response to these import price shock. There's actually too much because of stickiness in the non-tradable sector. There's a fall in real wages because of the adverse terms of trade shock, but also because of this excess reallocation and this fall in labor demand. So it's useful to do this optimal efficient allocation exercise to highlight what are the frictions in the model. It's the sticky prices, but it's also the intertemporal adjustment of bonds. So relative price shock, I think that's really important to highlight, that a lot of people think this is just a shock to the price level, but it is a shock to relative prices, which has real effects on the domestic economy. So point taken to highlight that a bit more. On the elasticities, yes. So we wanted to show that this effect is there without playing around with the elasticities. So something neutral, maybe too neutral in your perspective. But it is plausible that for the front-loaded fragmentation scenario, especially if we're talking about geopolitics, you might want to target critical sectors in the other economy. So yes, you want to do something that has target something that has in the short run has low elasticities of substitution. So that's one motivation for that. And we have different elasticities of substitution and extension. And we show how the effects in the gradual scenario could differ. But I think in the front-loaded case is the one that you would motivate most with different smaller elasticity substitution. In the long run, I think, market forces would adjust. You would find other sources of supply such that it's a higher elasticities of substitution. I have less to say on Guido's point, but point taken to take a look at that. And yes, I agree with you that it has some benefits for the transmission of monetary policy, but I'll take a look at the sources that you mentioned. Seems helpful for us to reference as well. Thank you very much. Happy to take other questions bilaterally if there are no more here as well.
There's no more question from the audience, then I take the occasion to, yeah.
So I thought that apart from the particular model that sort of set results as a benchmark, the questions there that they are asked are very important, particularly what kind of indicators may be relevant, what kind of so in the tariff debate, there's been a big debate about whether you want to abandon CPI targeting into more. The other thing I want to say is that if you ask trade economists, they live with one problem, which is the welfare relevance of this disruption is not that great. So this is something important because it's sort of this rejoinder with the monetary policy. And this is opposite to what people think, to what people feel, to what policymakers think, to what elections are won over. So there is something either wrong with the way we do it. Maybe we should have models that are more, there is more action, or more simply, there is something more to the trade disruption than simply the trade. I mean, this is like a new regime with many, many other things coming in. And all this comes to your way. I mean, I say that CPI inflation target is not optimal in the model. You tell people in the street, they would scream at that, right? Because the memory of the inflation in the past 2 3 years, we say, you gotta be kidding, I want you to keep inflation down, even if don't internalize the problem with activity. So this is what I'm saying. I think we're walking into a new regime that will make our certainties a little bit less solid than we had in the past. That's it.
Jenny, or reaction? Then I can come back to my doubt. I haven't yet understood. I don't know if I misunderstand the difference between the front-loaded and the progressive, but if I understand, in both cases, it's a permanent adjustment of tariffs, but in one case it's front-loaded, so it happens fast, and in the other one it's long. But in both cases, the expected final increase is the same. So why is the result then so different? Is it because you give space for these misallocations to have a feedback effect?
So thanks, Chiara. So clarify, in the gradual scenario that takes place over a long period of time, there's initial pullback in consumption because of the agents that do anticipate this and they see the whole path. And this affects aggregate demands in the economy, which affects labor demands of themselves, but also of the other households. In the case where it happens immediately, it doesn't matter if you can foresee it, you just adjust immediately. And so they both result in a fall in domestic inflation, but also what matters for aggregate inflation is what happens to imported inflation. And in the case where it happens immediately, it's a larger spike. In the case where it happens gradually, it's a smaller spike over time. Thanks for clarifying.
Thank you.